Hello, everyone. In this video, we're going to be going over how we can use Capital IQ to not only analyze equities on an individual basis, but utilize macro or top-down features to analyze a potential investment opportunity. So in this video, I'm going to be going over some of those top-down resources, such as the alpha factors or the macro templates, as well as some bottom-up investing analysis, which is looking at individual companies and even fundamental analysis that we use on CapIQ all the time to really leverage the software a whole lot better. So what we're going to be going over in this order, starting to get an understanding of what top-down investing is versus bottom-up investing and how these two styles can be used together. Second, we're going to go into a lot of that CapIQ macro data that we've got access to. They have a service called Alpha Factors, which rank different ways of viewing big picture, top level ways of analyzing different stocks and how factors are driving their performance. And then the templates that we have on Excel, and then how we can utilize that macro analysis to narrow down a screen of companies, which a previous CapIQ lesson walks through, to arrive at some of those potential investment opportunities. And when we do that, once we have our list narrowed down, that's when a lot of our bottom-up company analysis will come into play. And we're going to be going over some of these CapIQ services that will help will help our process in analyzing from this bottom-up perspective. And that includes a lot of that fundamental analysis, which the initial CapIQ class often goes through, and I'm sure many classes that you've taken have gone through, but we're going to try and take it a step deeper in the context of Capital IQ. But first up, let's get an introduction of what top-down investing is, bottom-up investing, and really how we can combine them to really supercharge our investing process. So when we think about top-down analysis, this is basically just looking at big picture economic factors when it comes to making investment decisions. All companies operate in some corner of the economy, and these corners of the economy are driven by these big picture events and big picture factors. One of the biggest movers is always interest rates, and how this is often a very significant element of what drives macroeconomic valuations. And the investment prospects for different companies within different sectors with different growth characteristics and maybe even products that they sell, think bank versus a tech company, for example, interest rates will always impact their businesses much differently. If you're thinking of just a basic example at the ground level of how these interest rates on a very big macro scale affect valuation, when you're doing a discounted cash flow analysis, a company's discounted terminal value, or the sum of all future cash flows, will be lower when you use a higher discount rate. And what makes this discount rate or weighted average cost of capital higher? Higher interest rates, which is why, as I record this in March of 2022, when the market is still selling off quite a bit and sold off over the last several months, especially in tech stock spaces that have very long duration cash flows, as we like to say. In other words, because they're such high growth companies, a lot of their high stock price valuations was baked in because of long-term growth. And when long-term growth is driving your valuation, if your interest rate goes up or your discount rate goes up, then your overall valuation will come down because you're discounting those future cash flows by a greater amount. And as I go through that sort of convoluted example of how interest rates impact things, that's really one of the main ways of thinking about top-down research. It's all about the interest rates. And interest rates are driving a lot of these indicators that help us provide visuals and help us understand some of the metrics that are driving economic valuations across the board. And we can think about these as leading versus lagging indicators. Leading indicators predict future economic performance. Think the Purchasing Managers Index, or the PMI, which is a measure of trends in manufacturing. When the PMI goes up, then chances are manufacturing around the world will go up, and it's indicated that the economy will go up as a result when we know that manufacturing is going to start heating up in the near future. But when we look at lagging indicators, these provide historical context of economic data, sort of where we've been and sort of the nature of what we're living in at the moment. And once again, as I record this in March of 2022, all the talk is around the Consumer Price Index. This is a measure of inflation. And when we look at inflation and the CPI measure, we're looking at on a backwards looking basis. Stock prices may be going up for companies that are positively impacted by inflation. Think things like materials or phosphates or chemicals and oil. All of these are performing very well in times of inflation. But if you really looked back, we were living in inflation probably before this CPI number even came to be, but it's only starting to break news because it's a lagging indicator and shows in a more visible way, an indicator of how the economy from a top-down approach is looking at the moment. And we can make investment decisions based off this top-down analysis. And like I said, if you thought inflation was going to spike months ago and you were going to try and get ahead of a lagging indicator and make a macro bet in that case, you would make an investment on a top-down approach, looking for a stock or an ETF or some sort of investment which would capitalize on something like inflation and do well in that case, getting ahead of the lagging indicators. And if you've got a really good perspective on leading versus lagging indicators and how we can analyze things on a top-down approach, we may be able to make some really strong investments in this case. But when it comes to looking at things from a bottom-up approach, this is more individual, company-specific, and often fundamental ways of analyzing individual stocks. And oftentimes, bottom-up investors, although they probably have some facet of a top-down macro approach, they are most often investing irregardless of a macroeconomic cycle. A true, raw, bottom-up investor, they say that they care less about macro cycles and they only truly care about the quality of an individual business. And how they define quality, of course, varies, but really the main ways that bottom-up analysis comes to find and decide on strong investments are, can they grow their earnings per share for shareholders, and can they achieve high returns on invested capital? That ROIC number is really generally, from a high level, pretty much the indicator that a bottom-up investor cares about. They may express ROIC in different ways. For example, they may look for companies with high profitability margins, or they may look for companies with high cash flows. But both of these are really products of their high ROIC. And what exactly would that be? Companies with higher ROIC gain better returns when investing into their business. Think about the components of ROI and C. They are returns, cash flows, on invested capital, cash flows that they invested into the business. When you make an investment in a company, perhaps let's think about a factory. If that factory generates 50% of your initial investment amount in 1 year after that factory was made, and the revenues generated as a result of that factory, or even the net income generated as a result of that factory, we can take that cash flow from the factory to determine, okay, we invested X amount and returned Y amount. Y over X will give us our return on our invested capital. The example there walks through it hopefully pretty clearly. Company A generated $100 million of cash flow from some other business line and invested that cash into a new factory, which generated $50 million of cash in its first year of operation. The company's ROIC for that year and that facet of their business is 50%. They returned $50 million for the $100 million of invested capital. And if a company could only generate, for example, 20% of ROIC on that investment in that factory, they're simply not as efficient when investing in their business, and perhaps may not perform as well as a company and thus as a stock. So this ROIC number is extremely important when gauging the quality of a business, and it often goes alongside growing your earnings per share. If you have an ROIC but can't find any avenues of growth, it's really not as indicative of a quality business. The best businesses are able to grow really fast and grow extremely profitably and continue to invest that growth into more and more opportunities that return similar invested capital. And when it comes to bottom-up investing, that's really the bread and butter of it. And these bottom-up investors, like I had said, they care less about short-term market conditions and volatile stock performances in the short term, but they're always trying to find these companies that have high ROIC and can outperform their peers over the long term. And this outperformance, of course, is driven many ways. Oftentimes in the short term, it's driven by crazes or driven by macro events like, we could call it a tech bubble of 2021 when a lot of tech stocks like Peloton or Zoom went up, several 100%. We can call it whatever it is. But those that will outperform over the long term are able to sustain high growth, sustain high profitability, and sustain additional capital investment into their business, which goes back to those first two, where they can keep growing from that investment and keep being profitable from that investment. And when it comes to visualizing those through metrics, revenue compounded annual growth rate over a long term, I've got 5 years written here, but even 3, 4, 5, 6 years of revenue compound annual growth rates, which CapIQ can calculate for us, and we'll get to in a second, helps us visualize the trajectory of a firm over a longer period of time. It's more wise to make an investment decision if you're trying to look for growth over a longer term CAGR versus a 1-year growth rate to truly get the full picture. But when it comes to profitability, gross margin, EBIT margin, and then eventually ROIC are also helpful metrics for visualizing how profitable a company is. And in addition to finding these quality companies, bottom-up investors, they're looking for those great stocks and these great businesses, but they want to pay fair prices for these. And for that we can use relative valuation methods like enterprise value and equity value multiples that help us gauge how a stock compares to peers and how a stock compares to its own historical valuation in terms of some form of earnings. When we look at enterprise value divided by EBITDA, that's telling us for each dollar that we generate of EBITDA, how much of the overall business does that account for? A lower multiple will mean that for each year of EBITDA that you generate, you perhaps are gathering more in your investment per year of that overall enterprise value. And when you can buy more EBITDA per share, for example, therefore you're getting a better price. And we'll see that visualized better on a spreadsheet. And a common quote of a lot of bottom-up investors is finding quality companies at reasonable valuations. And these reasonable valuations are always relative. When it comes to Microsoft, a great business, they'll always have higher valuation multiples than a company like Best Buy, simply because of the stark differences in their business quality. But that doesn't mean we can never buy Microsoft at a reasonable valuation, and just because the qualities vary. And we often have to pay up a little bit in terms of these multiples to purchase higher quality companies. So that's a general overview of bottom-up analysis. And we're going to get into a little bit more later about how we can utilize CapIQ to conduct more of this analysis. But to summarize which one to use, do we want to use bottom-up investing or top-down? It's really all about your own style, your own investing timeframes, and what amount of capital that you want to designate to certain types of investments. Together, they can both be a strong recipe. If you combine some facets of having an understanding of the macro economy, okay, where are interest rates going? Oh, wow, inflation as a lagging indicator is impacting these stocks, very interesting. But then if you can utilize that alongside a bottom-up investing approach, where you see all these macro news factors and everyone on the front page of newspapers, everything they're reading about. But if you can truly take all that with a grain of salt and still analyze quality businesses that may have, in your own opinion, become misvalued as a result of big picture things. For example, if a big picture global issue is causing your stock to sell off, but nothing's indicating that stock's business model or profitability or ROIC will truly be impacted, perhaps that could be a good time to pose that opportunity as an investment. And that's where combining these two could really come into play. Understanding what is driving your valuation from a high level. Is there some big picture that's determining some sort of valuation discrepancy? And then identifying those quality assets as a result, where you can potentially get a quality price. So now, as we get into Capital IQ, into some of the macro investing tools, we'll start with the Markets tab on CapIQ. And I'm going to be cycling between this slide deck and the actual Capital IQ website. But first, to go over the Markets tab, it provides industry analysis, macroeconomic data, commodity prices, and some of those interest rate figures, all of which have enormous macroeconomic implications on any of your investment decisions. And they're all outlined pretty intuitively on these various tabs over on the left-hand side of the screen, where we see various subjects that this section has. And they all outline them pretty well on pages like this, which is outlining a lot of industry analysis. And just on this page, once again, as I record this, we can see that energy and oil and gas, metals and mining, those are all really outperforming not only the S&P 500, but some of the worst performing industries over on the right-hand side, like auto and IT and textiles and consumer goods. Pretty interesting to see it stack up like that. And this is helpful from a big picture, getting a broad understanding, okay, what different markets are outperforming. But then we can dive deeper and come to get a better understanding of what could be driving some of these valuation differences. So I'm going to pull over here the CapIQ page, and I'm going to go into markets to access that page as listed on that PowerPoint. Left click into there. And this will bring us to just the overall market analysis page we were just on. But say in this example, we want to look closer at something like oil and gas because we saw it outperforming on this chart. We can go into here and see a lot of the different prices for oil and gas as laid out using CapIQ software. We can see some of the futures prices and then the forecasts for a lot of these metrics, what's being forecasted as some of the Brent crude and crude oil prices in 21, 22, etc. This is really helpful. But now if we go into something like where the interest rate section is, if we want to get an overview of what interest rates are doing and how things are looking, we can click into here to see overview. And right here, we get a pretty high level understanding of, in a visualized way, what the yield curve is looking like. And this yield curve is extremely helpful when it comes to getting a general perspective on what interest rates are doing, in this case, in the United States. We can see that the curve is pretty, somewhat steep up until these medium-term maturities. Then we really see it flattening out. And if you're familiar with interest rates as a macro indicator and an economic indicator, when the yield curve flattens, a lot of people are looking for that recession, a flattening yield curve. I know the 2-year and the 10-year, when this one flattens or inverts, people have used that as an indicator that a recession is near. Right now, there are many things driving the market. I'm in no position to project, but this will help us get a picture of, this one seems to have inverted quite a bit, where a shorter term maturity has a higher rate than a longer term maturity. We see that yield curve, which should be going up, go quite a bit down. That could be interesting. And that gives us a perspective on interest rates. And we can see all kinds of not only United States interest rates, but some Euro interest rates as well. And we have some Japanese debt right here that we can start to look at. But all kinds of different interest rate data available on this page. But in the sake of time, I encourage everyone to look at the markets tab on their own time, because it should be a really good first step with analyzing investments from a top-down approach. But to move forward to another service on our CapIQ software is the alpha factors. And when we think of the term factors, these are specific quantifiable categories like size or volatility or growth or momentum that lump various stocks into these categories and see how returns are being driven per each of these categories. Meaning, are companies deemed more sizable or larger? Are they outperforming? Or are more volatile stocks outperforming, or growthier stocks outperforming or underperforming? And these factors help us visualize these pretty big categories that a lot of investors naturally look at without knowing to rank them by factors like this, that give us a perspective of what is and what isn't working on the overall market. And these categories can really help educate our investing analysis and helps us boil down and group various assets. In Capital IQ, the alpha factors section, they have various categories, and they're listed right here on the screen. And each of these categories have various specific calculable metrics within them that help assign rankings. So when we look at the growth category, the growth factor, this one uses metrics like revenue growth and earnings per share growth to establish the rankings of the most growth-oriented stocks. So companies ranked as the most growth-oriented will have had the highest growth in terms of revenue or EPS over the last year or two. And these more growthy names will be more attributable, the performance of these growthier names will be attributable to the factors within which it resides. And we can get a pretty good representation various growth stocks in terms of real quantifiable categories. When it comes to the size category, it's much of the same, but it uses market capitalization and nominal value of sales to assign rankings of big versus small. So when we think of some of the biggest companies in the United States, they would be ranked much higher in terms of how they rank, in terms of how they measure alongside this size factor, like Amazon or Microsoft, or Walmart. Some of the companies with the most sales or some of the largest by market cap will be simply ranking higher in terms of the size category. That's pretty intuitive. And all of these various categories are ranked much of a similar way. And we'll go into some of these different metrics that determine rank within these categories. Alpha factors, they aren't just useful for analyzing individual companies or ranking individual companies based on these categories, but they give us a really helpful big picture analysis of some of these metrics that are performing differently in the overall market. When we look at this chart, we can see clearly that some of these top metrics are performing better in terms of stock price year to date as of March of 2022. And some of these we can see are all attributable to the VAL style. What is VAL? That's valuation. Valuation in terms of what stocks look cheaper in terms of valuation. The market right now is clearly preferring to invest in cheaper valuation stocks as determined by some of these metrics right here. All these metrics are being ranked to coincide with the stocks that are most attributable to these rankings, and have, in this case, the highest EBITDA to EV ratio, which I know I said earlier, EV to EBITDA, I flipped that ratio. If we have a lower EV to EBITDA, that's more indicative of valuation, but a higher EBITDA divided by EV is in terms of is indicative of a cheaper stock as well. So sorry to confuse it. CapIQ's alpha factors, we're going to learn they are a bit strange, but in terms of what stocks are deemed to be more value stocks, we can clearly see these ones are outperforming. And this mosaic helps us get an understanding of how these different value stocks performed in various other years. In 2020, not many stocks did all that well, but these did particularly poorly. And they frankly have done somewhat poorly, with the exception of 2016 and 21 and year to date in 2022. But this really helps us get a picture of what is and what is not working on the market. And if we look at, for those familiar with stock moves in March of 2022, we know that a lot of the higher growth names have been getting killed on the market. And we can see that at the bottom here. And we see that these growthier stocks are underperforming all of the other factors as determined by Capital IQ's alpha factors. So once we have our big picture understanding in terms of alpha factors, we can look more deeply at the company level analysis available on this service. And the alpha factors can be used for each category within growth or size or valuation to benchmark the individual companies against an overall stock index. So in each individual company is benchmarked in terms of, say, in terms of size based on how large they are in terms of market capitalization, or they're benchmarked by quality for those that have higher returns on invested capital. Those that have higher ROIC in terms of the capital efficiency or quality category available in alpha factors will be ranked higher. So CapIQ is helping us sort of screen for the most capital efficient. In other words, they return more capital per dollar invested into the business. And CapIQ's alpha factors are ranking these higher ROIC companies for us that we had just talked about as perhaps the ones that we want to invest in. And CapIQ benchmarks these on a scale of 1 to 100. And this is where it starts to get confusing, so bear with me. A score of 1 is the lowest number, meaning the lowest ROIC ratio or the lowest market capitalization number. They are ranked as 1, so they're the lowest, while 100 is the highest number. So this is tricky because if you're trying to screen by size, for example, and you're looking at how market capitalization is ranked within size for these various companies, those that have the higher market cap will be ranked as 99, 100, higher numbers. But if you just start your screen, you'll see, oh, well, number one, these are the biggest companies. But if you look closer, they are extremely small and have smaller market capitalization. So it's important to understand what these ranks mean. And that example right there is how our ROIC is gauged in the alpha factors. Companies with higher ROIC, they often gain better returns when we invest in them. So higher ROIC calculations should be better in terms of our alpha factors. However, within the CapIQ alpha factors and how these companies are ranked, the ratio is actually free cash flow divided by ROIC. So as our ROIC grows, which is what we're going for, that ratio will actually get smaller. So we want companies that are ranked 1, 2, 3 in terms of alpha factors. So in that case, the smaller metric is actually better. And this distinction is obviously very confusing in terms of the alpha factors, but it's very important because we really have to have an understanding of what we're looking at and how these lists are ranked. Because if we were looking for the best ROIC companies, so the best ROIC companies have the highest valuation. So therefore, company 99, company 100 in terms of the rank, that's the one we want to buy. It wouldn't take us too long to realize, oh, wait a minute, this ranking is actually inverse, and these do not have the highest ROIC in terms of the overall benchmark. So the bottom line is alpha factors will rank the lowest calculations number 1 on the 1 to 100 scale, and the higher calculations number 100. But better can be defined on either side. And one bullet point I skipped there, the CapIQ rankings, for whatever reason, I really can't figure this out. They're only available on weekdays when the market is moving. I've tried running this screen on weekends, and it's just not possible to use these alpha factors, and it's extremely annoying. So for this case, it's best to use this during weekdays. If I'm going to click this link right here for a sec to just give us a better visualization of some of these factors, when you go to CapIQ, you'll go into alpha factors on this menu, and you'll come to the factor catalog over here. Factor catalog, all categories is where we're at right now. And here you can start to look through some of these different factors that are available for us to gauge rank in terms of these stocks and how they coincide with these metrics. The cash flow return on invested capital, remember this metric we just talked about, the lower the ratio, the higher the ROIC, we can see how these companies are. And when we click into a factor, we can see how this overall category, this overall metric has performed in terms of the market and generally some metrics and visualizations for us to understand that better. And this is once again one more visualization of that cash flow to return on invested capital way that I just explained verbally. Hopefully this visualization helps us understand that in these calculations here at the top. For the sake of time, I'm not going to go too deep into it, but this slide deck is of course available for you. But as we look at this, you look at this table right here, we see ranks 1, 2, 3, all the way down the line. And because I just introduced it, cash flow to return on invested capital, the best return on invested capital companies will have the lower benchmark ranking. So these are some of the best ROIC companies within the overall index that we were analyzing of the S&P 500. Some of the ones that I personally know, Domino's has great ROIC, AutoZone and O'Reilly do as well. And of course, it should be no surprise that Apple is one of the best ROIC companies as well. And the CapIQ alpha factors helps us visualize that too, which is nice. And one more to visualize that market capitalization example I went over. When we look at how these are ranked, obviously companies like Alphabet, Amazon, Apple, Microsoft, even Berkshire Hathaway, these are some of the biggest companies in the world in terms of market capitalization or sales. And we can see that, if we want to invest in size, we'll have to look towards the back end of these benchmark rankings because these are ranked 100 to 99, et cetera. So now looking at how we can utilize the CapIQ plugin and the various macro or micro templates that we've got access to thanks to AI generated models that CapIQ already built for us, we can start to utilize the plugin a whole lot more. And if it provides us these modeling templates and we can access them, and they're extremely helpful in expediting some of our investing analysis. But one thing to note, these templates are often very large files and take a really long time to download. So I've already downloaded one for us. So if we go to our Excel page and we've got access to our S&P Capital IQ part of the ribbon right here. If we click into templates, left click, and then go into get/update templates, we can download any sort of financial model over a range of different topics that could help us in our research. We see there alpha factors, which we've looked at, and we can see how, if we click into this little crosshair, various ways that we can help our screening and educate our screening on some of the categories we've already talked about. We can also look based on commodities if we want to look at commodity performance relative to all the other commodities that CapIQ can price for us. But if we go down to estimates, which is the one I downloaded for us, we can see on a bottom-up sort of investing approach how analysts are projecting a various companies' revenues to come out or various companies' earnings per share to come out. And these models bring together on an aggregate basis all sorts of different companies that we may want to potentially make an investment on or simply research when it comes to the earnings that may come out. And that's the template I downloaded for us. This is the Earnings Watch dashboard. This one helps us get a picture of what amount of companies beat earnings or what amount of companies missed earnings. And we can see it laid out here for us. This one, it seems to be second quarter of 2019. But if we click into quarter selection, and once again, this will take a lot of time, so I'm not going to do it at the moment, we can select any sort of quarter we want. And I believe there's a spot to change the year as well somewhere in here. The instructions should be able to lay it all out for you for this Earnings Watch dashboard. But the main idea here is analyzing in terms of each individual industry, the number of companies that have already reported out of however many companies have yet to report earnings. And when it comes to, if we scroll down, what percent we're able to beat on both revenue and EPS, or which ones only beat on EPS or only beat on revenue. And this helps us get a picture of which industries are potentially performing better or performing better than expectations, which is where real investment prospects could come in. And it's really helpful seeing it all lined up here. And we can analyze it on a focused company basis. In this case, we've already got Coca-Cola typed in. We can change the ticker right here. Again, it'll take me a while if I change it, but the Coca-Cola company is outlined in terms of its analyst ratings right now. We can see consensus target prices, and these charts aren't updating at the moment. I do apologize about that, but if we do press update, it might go, but it could take a while. But usually those charts should be able to fill out for us. And if you play around with it and insert different companies that you want to analyze, this model should be pretty helpful with just getting a picture of earnings dates and potentially what industries are performing a little bit better than expectations. But there's all kinds of different templates that this CapIQ plugin gives us access to. And some of them, if I go back, are pertaining to macro factors. If we scroll down, the macroeconomic models down here, we can see simply macro charts or different macroeconomic events that could sway prices on a top-down investing approach, and various macro models like that. But there's DCF models, there's valuation models like comparable companies or DCF or calculate a WACC, whatever. But there's so many different models in here that we can access. And this earnings estimate watchdog is one of them that's pretty good as well. So to go back here to the PowerPoint, to summarize some of these various macro tools that I've talked about, I think personally, the best first place to start to just gain a high level understanding is that markets tab we started with. From there, you can go to the alpha factors to understand on a more granular basis what types of companies, growth, value, big, small, are outperforming or underperforming at any given time. And from there, we can go into a screen, which I'm going to go into in a second, to help educate our factor research. And from there, perhaps we can augment our research with some templates. And if choosing to invest based on a purely bottom-up approach, qualitative based factors that indicate growth or profitability and efficiency, those three are oftentimes the best to use. And things like and various factors like momentum, volatility, and analyst expectations, these don't pertain as closely to a pure bottom-up investing approach. Stocks that are more momentum stocks, momentum could be attributable to true qualitative factors about a company. Are they more profitable? Are they growing faster? That could coincide with momentum, but momentum is oftentimes performing as driven by perhaps macro factors or simply driven by institutional investors, things outside of the true fundamental investor scale. And for that reason, using different factors, potentially more than others, could be a part of your process that you want to consider. But all these factors tell us something pretty interesting, and the various metrics within them can be pretty educational for us. But that'll wrap up the macro tools. So now how to narrow down an investment based on these macro tools, we can go into a bit of a capital IQ screening exercise. So let's say you're looking for somewhere to invest, and you notice that so far in 2022, the value factor outperformed as based on that mosaic we showed earlier. And you're a little worried you missed the boat. So you're not going to invest in value stocks. Instead, you want to find a stock in the S&P 500 with just truly really high earnings quality and really high growth. Two factors which have underperformed over the last couple months, but usually perform pretty well in the grand scheme of markets. So to use alpha factors to narrow down our search, we're going to use a CapIQ screening during a weekday to narrow down based on some of the following metrics that are more alpha factors driven: 1 year change in EPS, cash flow to ROIC, 1 year change in shares outstanding. And in addition to these alpha factor metrics, if we think a little bit deeper, all kinds of other metrics could be attributable to some of these factors that we want to invest on. We want to invest on quality and we want to invest on growth, two pretty big picture factors. But it's not just the alpha factors metrics that can help us visualize a quality company or a growth company. And for this reason, we can utilize some of those traditional capital IQ metrics like 5-year EPS CAGR, 5-year revenue CAGR, like turnover ratios, like asset turnover, which is calculated by our revenue divided by total assets. And I have last 5 years there because, and I had sort of alluded to it earlier, the most quality companies are able to have repeating metrics of similarly strong amount. So a high asset turnover metric just last year, that could mean a number of things. Maybe it was just an anomaly strong year, but an asset turnover ratio that was really high over 5 years, or an EBIT margin that was really high over 5, 6, 7 years, repeatedly strong, that could be more indicative of a strong investment. And for that, we can use CapIQ to help our screen and see it more on a big picture perspective too. And one more metric I threw there at the bottom, free cash flow yield, which is the free cash flow we generated per dollar of the company's overall valuation. If you generate more free cash flow as a percentage of your overall company's value, that could indicate a better value of the stock that you're getting because you're getting more free cash flow per dollar that you invest into the overall business. So I pulled up this screen on Capital IQ before, and I already downloaded into Excel, but I want to first show how we can bring it up on Capital IQ too, and go through the steps of that screen. So on CapIQ, we can go to the main page here if we click and go home. But if we go to screening and left click, we can begin a company screen and start to lay in some of those metrics that we want to analyze. And I know if you've done the CapIQ class, you've viewed another screening video, we could narrow down simply and eliminate companies within the overall index that we want to invest in this case, the S&P 500. But I personally prefer analyzing all of the companies in one space. So simply outlining all the metrics that we could want to analyze and not eliminating any companies based on that metric. And I'll get into more of what I mean by that in a second. But the first criteria that we do want to eliminate companies by is the index. I said we wanted to invest in an S&P 500 company. So we're going to go into, for me, it's one of the most used. We can also go into equity details, this area right here, and left click on indices. We want to access only companies within the S&P 500. So I'm going to left click, but then I'm going to click primary listing. So these companies are primarily listed in the S&P 500. Left click that arrow, add criteria, and we should have 500 companies from which we're going to choose our high earnings quality and high growth stock. We'll give it a couple seconds, but once the number is lined up, and I guess, well, it's not fully 500 that are only primarily listed on the S&P 500, but now that we've got our 500 names, we're going to customize display columns, left click, and here we're going to insert some of those metrics that we wanted to use to analyze our company. And we're going to go back to the PowerPoint here because I outlined it right here. Once we've inputted all of our various screening criteria, the various metrics that we want to use to analyze whether or not a company is of high quality and high growth. They'll all be outlined here. In this case, we're going to use 22 of them, but you'll notice a few of those are over a 5-year basis. We're trying to get total asset turnover over 5 years. We're trying to get EBIT margin over 5 years and even free cash flow over 5 years, because once again, we're trying to find quality over time rather than just quality over 1 year. So I'm going to go back to CapIQ and start to input some of these metrics. I'm not going to input all of them because I already downloaded into Excel, but to get those main keystrokes, we're going to go into browse all display columns to start to get these metrics for us. And we're going to go into Alpha Factory library factors. This is where we've sort of been talking about throughout. And these are some of these indicators that have, these are some of these metrics that coincide with these overall factors that we can use to analyze companies. And remember that first one was 1 year change in earnings per share. The alpha factors will rank our companies based on which companies grew their earnings per share the most over the last year. And I know we've talked about more of a long-term perspective on ranking these companies, but this is just one way we're deciding on what the growthiest name is. A lot of these companies may have had 1 year anomalies in their earnings per share last year. And a lot of these, though, are consistently strong at growing earnings per share. But we're going to let CapIQ Alpha Factors rank these companies in terms of the S&P 500. So I left click 1 year change in earnings per share. And as I was talking, I just simply clicked into the category I was looking for, the historical growth category, which brings us to the 1 year change in earnings per share. We're going to add the columns. And here, we didn't eliminate any companies. We're just simply looking at a metric we want to visualize for all of the companies. And we're going to do the same thing now for 1 year change in shares outstanding. That was one of the next alpha factors I wanted to analyze. Why would that be important? Well, oftentimes some of the highest quality companies generate so much cash flow that they can only invest so much into their business, and instead want to invest some into simply giving it back to shareholders. In one way, many companies give money back to shareholders, and it's oftentimes a pretty effective way of giving money to shareholders is buying back stock. When there's less stock in the overall market, each individual share naturally becomes worth more. And this will be available in our capital efficiency category, where we can see 1 year change in shares outstanding. And this one will rank based on what number of companies had the most shares bought back. And the change is a percent change. So if we're buying back shares, the number of overall shares outstanding, that number will decrease. So we're going to have a negative percent change. And remember from earlier, the lower the number, the higher the rank, higher in terms of 1, 2, 3, and 4. So we're ranking those higher. And that makes sense because we want a lower number here to be ranked more favorably in terms of this factor, if that makes sense. I'm going to analyze it here in a second, but we're going to left click here, 1 year change in shares outstanding. Once again, they're going to be ranked lower, the most shares they bought back, et cetera. And those are pretty good ways of visualizing the alpha factors. There's a couple more I downloaded into our Excel sheet, but just to show now getting data over a longer term scope, I'm going to insert EBIT margins over the last 5 years. And to get EBIT margins, that's a financial piece of information. So I'm going to get into financial information right here, go into financial statements. And this is where we've got access to all the statements that a company could report and the various numbers that are that are coming on those statements. But in this case, we want a specific ratio. So we're going to go into our CIQ operating metrics and ratios, and EBIT margin is a profitability ratio. And we're going to click into profitability and margins. And we've got all kinds of different types of margins to look at, but what we want is EBIT margin. EBIT margin is operating income divided by total revenue. And operating income is a better indication of the overall efficiency of a company because operating income is all of the earnings that they generated from their core business operations. So it's a pretty helpful metric to utilize for us. So in here, we've got this little menu here where we can select LTM data, or we maybe just want the last full year EBIT or the last quarter EBIT. In this case, I want the last 12 months. But we could do this over and over again by doing LTM -0 for the last 12 months, or LTM -1 which is the 12 months before the last, or -2, -3. But CapIQ makes it quicker for us because we can just choose LTM, but we can give ourselves a display range over last some number of years. In this case, I want the last 5 years of EBIT margins. So I'm going to left click into 5. And these are, once again, where I can choose years. I want the last 5 years. I don't want the halves or the quarters, the months or the weeks. I want the years. And now if we press the add to column, it'll give us 5 more inputs because this is the LTM EBIT margin, the one before that, the one before that. And it gives us a helpful way of visualizing an EBIT margin over time. And you can do this with any sort of metric. It doesn't just have to be a ratio. It can be a growth ratio where you just want to see, EBIT 1-year growth over the last 5 years. So what they grow last year, what they grow 2 years ago, 3 years ago, etc. And you can also use it in one area that I really like in the multiples. So if I close out some of these, valuation and CIQ multiples. We've talked a little bit about EV to EBITDA and price to earnings, but we can see these outlined in daily trailing multiples or daily forward multiples. If we click into daily trailing, we can see things like TEV over total revenue or TEV over EBITDA, TEV being total enterprise value. And this helps us visualize the overall value of the company. For example, this is just generalizing, a TEV over revenue multiple of 1 times is indicating that that company is a whole lot cheaper than a company with an EV to revenue multiple of 10 times, because you're getting more amount of your revenue per the overall company when you buy that individual stock. That multiple lower perhaps means we're getting a better price. And once again, just finally, we can left click into any one of these multiples we want and input whatever sort of whatever date of the multiple we want. We can input the latest multiple, or if we want to see how that multiple has changed over time, we can press date and click this little calendar icon, and we can move around this calendar. Say we want the EV to EBIT multiple from 2021 of March or 2019 in March, etc. And this helps us visualize those multiples over many years. But I've inputted a couple in here, but once we've done all that for all of these metrics that are indicated on this screen for you, if you want to participate, then you download it to Excel, and I guess I should show that 1 second. Once we have all these metrics in, we can press view results, and it'll take a couple seconds to download. Once you've done this and you've got all the metrics that you want to analyze, and because you've done this during a weekday, you can see the alpha factors laid out for you. It's very strange that you can't do it on a weekend, but I digress. Once you've done that, you can download into Excel, left clicking here into the Excel button and press go. And it'll give it a couple seconds. It'll generate the report up here at the top of your screen. Give it a couple seconds. I know it'll take a while because I'm streaming this, but once this finishes downloading, you can press download, and it'll download just like any document that you may have downloaded in the past. And once now, it downloaded 100%, we can click download, and we've got access to our file. And that file should look quite a bit like this file. So once we've downloaded this document, we see a whole lot of different numbers, but we don't really know how to rank the companies that are truly the best or ones that we want to invest in terms of these various metrics. So to better visualize which companies are more in line with those that we want to buy, we can utilize conditional formatting and highlight those that have the best measure. We'll start with 1-year change in earnings per share. Those that have the lowest numbers have changed their EPS the highest in the last year, and that's what we want. That's the most favorable measure. So if we go into conditional formatting, we first, though, want to highlight all of the selections, Control, Shift, and then arrow down. We will left click on conditional formatting, highlight cell rules that are less than a specific number. And in this case, because we know they're ranked 1 to 100, we're going to want to highlight the companies that say are in the top quartile, the top 75 or whatever. So we can highlight those based on those numbers that are less than 26, because those that are less than 26 will have had somewhere in the top quartile the best earnings growth over the last year. And just because I think green is more indicative of better, I highlighted those. I selected to highlight those with the green fill, and I pressed OK. And now we can see which ones highlighted perhaps had the best EPS in terms of growth last year. It should be no surprise that Google is on that list, for example. But now moving forward, we want to see those that had perhaps bought back the most stock last year. The better number is a more negative percent. So contrary to that EPS example, where we highlighted those that had lower numbers, even though the lower number was attributable to a higher EPS growth. In this case, what we want is still that lower number, but that lower number is more indicative of more shares bought back. So we want to once again highlight those that are less than, let's say 26 again, and highlight them green, and press OK. So if we know, how these companies are, we know that these are some of the companies that bought back the most stock in the S&P 500 last year. And just as an anecdotal example, Advanced Auto Parts, that should be no surprise that they bought back a lot of stock. And then AutoZone, they buy back a lot of stock too. If I scroll down to AU, searched it, but where'd it go? AutoZone, yes, they bought back some of the most stock in the S&P 500 last year as well. That's one of their core capital efficiency models. Finally, we once again want to highlight the companies with the best cash flow to return on invested capital ratio, conditional formatting, highlight cell rules that are less than 26, highlight them blue, press OK. And this will help us visualize, which companies had the best ROIC last year. But if we type in Apple, if we Control F Apple had some of the best ROIC last year, and it's ranked that way in terms of our alpha factors, which makes a lot of sense. Finally, the last one I'm going to highlight, the rest have already been highlighted where they need to be. We have our diluted earnings per share growth over the last 5 years, our 5-year compounded annual growth rate. And this isn't an alpha factor, so this isn't on a scale of 1 to 100. So how we can highlight these conditionally can start with first calculating the quartile, because we calculated and we highlighted those that had upper quartile measures in the last 3 sections. These are the better numbers in the upper quartile. We can calculate here at the bottom the third quartile for these CAGRs. So all these various numbers, we can use the Excel formulas to press equals quartile, highlight the range, and then type in 3, which is how that formula measures the third quartile. We can see here if we type it in. Oops, type in the wrong one. There's various types of quartile measures. You can of course have to spell it right, but I prefer the one at the bottom, quartile. I press tab. I want to highlight the range, holding Control Shift and then arrowing around to highlight our prospective range. Pressing comma then, and you can see here we've got third quartile. So I'll press 3 and close the parentheses. And here we've calculated the upper quartile of EPS growth over the last year for the S&P 500. So now to conditionally highlight, the best growing companies, we'll go back into conditional formatting, highlight cell rules that are this time greater than that number that we calculated. And in this case, rather than typing in 23, we can scroll all the way down and we can simply reference that cell where we calculated our quartile and close that menu and highlight it green. And in this case, we've calculated already, but we've referenced a specific cell that will stay referenced when determining those with the best growth. And we can sort of see already some interesting CapIQ formatting issues. When it's a dash, it doesn't interpret that as a number. It doesn't interpret that as 0. And instead, we need to scrub this data a little bit. And to do that, I will press Control Shift, then arrow up to highlight this column. And then I'll press Control F to then click into Replace. In this range, I want to replace any dashes with a 0. So they don't highlight because they did not, as far as we know, grow the best in terms of EPS over the last 5 years. And I'll press Replace All. They made 140 changes in the S&P. Close. And now we've got a much better way of visualizing, because these are no longer highlighted, those that had the best growth, the upper quartile growth over the last 5 years in terms of their earnings per share. And I did the same highlighting, just in the same way of calculating the upper quartile for revenue CAGR. And then when it came to our total asset turnover, which of course We input it over a number of years. We input it over that over 5 years. We get to then what I calculated to be the median total asset turnover over those 5 years. Remember, I've been harping on that a lot, how a lot of bottom-up investors will not just look at 1 year's measure of asset turnover or 1 year's measure of EBIT margins. They will look at that data over a number of years. In this case, we looked at it over 5 years. And to truly assess those companies that are better or stronger, I took the median of those 5 years. I sort of normalized this data because oftentimes, in terms of asset turnover, a company's number will fluctuate over time and over many years. But the best companies, perhaps, are consistently high performers and consistently put up total asset turnovers in the upper quartile. In this case, I already calculated the quartile at the bottom. That's actually quite surprising that the total asset turnover is less than 1 as the best in the S&P 500. But I did the same conditional formatting to highlight those that have asset turnover over 0.86, and these highlighted green just the same, using that conditional formatting. And now we can start to see, okay, just the A.O. Smith Corporation, or if we scroll down, what's a good reading? 1.51 is decent for AMD. AMD's been performing really well over the last few years. That one's been growing pretty fast, and their ROIC number appears to have been pretty strong too at number 4 last year, as determined by the CapIQ rank. That one is starting to look a bit more attractive. That stock has been doing really well, and the financials are showing that for us. But if we move forward, we can see I did the same calculation then for the EBIT margin. I calculated the median over the last 5 years for each of these individual companies, and then I calculated out at the bottom the third quartile EBIT margin, the operating margin, as performed as done by these individual companies, highlighting those that had the best margins. Okay, some are looking pretty good. AMD, they didn't have a great operating margin, so they're clearly more of a growth play. That's where a lot of their numbers are doing really well. But some of the most profitable companies, I want to check back in on AutoZone. That's a pretty good one. Let's see how their EBIT margins stacked up. Not bad, not the best. It's a retailer. It's a tough business. But I reckon if we keep scrolling and perhaps find Apple, their EBIT margins might be pretty good if we scroll over. 26, yep, they deserve the highlight. They're doing quite well. And then I bet Google, we type them in. I guess it's Alphabet. I'm just control Fing to find it and get to it quicker. I bet their operating income margins were pretty strong. Yep, 23.8 over the last 5 years. And you can see last year, the last 12-month period, Google did really well. They had a record EBIT margin compared to the other 5 years, 26, 23, 22, 22, all the way up to 30. And that could continue. Maybe Google set the stage to never go below a 30% EBIT margin again after really strong 2021 performance. I don't know where the bet would be in terms of that, but that's why we take the median. That's why we sort of normalize the data to sort of discount some 1-year performance and see if companies could truly repeat that number. If we look at Amazon, Amazon's never really been known for great operating margins. That doesn't mean it's a bad stock. It doesn't mean it's a bad company. But this way of measuring really helps us out. So I'll stop looking at individual companies and go over to our next and final metric. And this is one we have to do a couple steps to analyze. And that is our free cash flow yield, which helps us understand per share, what is the free cash flow being generated. They say in investing that your total stock return should be the free cash flow yield per share plus any earnings per share growth that you experience for that year. Why? Well, stock valuations are driven by what? Cash flow. That's the whole point of a DCF. And when you're able to generate however much percent per share of free cash flow that's attributable to equity investors, because we're calculating this based on the total value of the company, we can get a decent approximate valuation of that stock's return. If their free cash flow is expected to be, in this case, the top one, 5% of their overall market cap, that could be attractive if they're also growing earnings per share by, say, 5%, giving us sort of an approximated stock return of 10%. If we take that, without scrutinizing it any further. But to get to that two-step process, we first needed to input our unlevered free cash flow over a number of years. And in this case, I also calculated the median unlevered free cash flow, but it perhaps won't be as helpful. And Here's why. Oftentimes, some of these companies will grow their earning, their unlevered free cash flow. That's the whole reason to invest in a company. But it still could be wise to discount this growth to conservatively measure what could be a conservative number of conservative amount of free cash flow that we could expect for the company. So if we look at 3M, 5 years ago, they generated 4.3 billion of free cash flow, and then they grew that free cash flow in the last 2 years to 6.4 billion and 5.3 billion. Perhaps I'm being a little too conservative by taking the median, which makes our projected sort of free cash flow that we're using for this number, for this metric, less than what they've done in the past couple of years. But I personally think this gives us a margin of safety when calculating our free cash flow yield, because even if a company has been putting up really strong numbers, but comes back down to what they've been doing at their median level, and even if that's the case, and we still project a pretty decent overall yield, which is just the free cash flow divided by the overall enterprise value of the company, and it's still decent, even though we're using a conservative number for our free cash flow, that's just simply conservative investing. And oftentimes, conservative investors may not, get the best stock that performs in a year, but they usually won't blow up their account. And if we're looking at this from a conservative lens, this could be a best practice. But you could, of course, also make this calculation in terms of the record free cash flow. If you're bullish on the stock and you think their free cash flow is just going to continue to grow, you wouldn't really want to calculate this metric based on the median, but instead you would want to make this equal to their record free cash flow, and you'll calculate it differently. I don't know why this formula didn't update for us, but if we do the free cash flow divided by the enterprise value, you see there it went from 5% all the way up to 6.6%. So it's all in terms of your fundamental understanding and fundamental expectation about this company. And that's the whole nature of what we've been talking about, right? But from a very conservative perspective, I calculated the median free cash flow in terms of their last 5 years for all of these companies, and divided that by the overall value of the company to arrive at some free cash flow yields. And if I go to the bottom, I see the upper quartile free cash flow yield was 4.3%. And any company that put together a free cash flow yield, as we've sort of projected in terms of the median free cash flow that can reasonably be expected based on the company's trajectory, we can highlight and see those that potentially could be helping us get the best bang for our buck in terms of buying the stock. Typically, a higher free cash flow yield could be better value stock for us. And I'm starting to notice that a lot of NAs were highlighted. That could simply be the same case from before. We got to Control F and eliminate any NAs. But that should hopefully be a helpful walkthrough of the free cash flow yield analysis that we can do on Excel once we've downloaded things to our Excel from CapIQ. But narrowing down that list it's not as easy as using the CapIQ screening function to just narrow down to 10 companies. It takes line by line analysis like that to help us get a better perspective on some of the best and worst performing companies in terms of those metrics that we've been going over, whether it's free cash flow or EBIT margin or total asset turnover. And going one by one and highlighting the best ones, we can start to assess, in this case, which ones have better capital efficiency, which ones are growing best. So finally, once you find your stocks that you like, I think this is a pretty general but hopefully helpful description of how you can familiarize yourself with that company, and you can do all of this on CapIQ. So I'm going to go back to CapIQ and a company that I've been talking about, and was sort of if we go back here, I know AutoZone wasn't the best in terms of growth, but they were pretty strong in terms of capital efficiency. And Apple, they were pretty strong in both cases. So was Alphabet. So for that case, we could keep going through this for a while. For the sake of time, I'm not going to pick and choose the best EBIT margin and the best growth company. So I'm just going to make a assumption that I think is a pretty fair one to suggest that Apple is one of the most capital efficient and one of the highest growing companies in our overall list. And from here, we're on Apple's page. I simply typed it into the ribbon, and we can start to analyze it further. I personally think the best first step to analyzing a company is to go into the long business description here in the company summary. This gives us a great place to start because it walks through everything that you could need to know about how the company makes money. This is a great fundamental first step for bottom-up investors that before trying to understand the numbers, they need to know where those numbers came from, what they sold. And this business description will really help us out. But once we know what they sell, we can start to try and assess a trend in the numbers and utilize the key stats page on the financials and valuation to be the first step in assessing those numbers. If we look at Apple, we can see just from the top, okay, their revenue has been chugging along pretty strong. They've been growing. Their gross margins have been pretty steady, but really expanded over the last couple of years, indicating higher profitability and maybe even higher pricing power in terms of how they're selling to customers. And when that gross margin went up too, so did their EBITDA and their EBIT margin. And that's where when we calculated the median on our analysis, we probably calculated it to be 26.7 as the median EBIT margin. But that doesn't even tell the whole story of what Apple has done in the last couple of years, which is growing that EBIT margin up to 29 and 30. And maybe the company is able to sustain that level of margin. Maybe it stays up there. Who knows? But we gave ourselves some conservativeness. But perhaps they keep the margins up that high. But this page, the key stats page, gives us a helpful trend of where their financials are coming. But if we want to go into the specific financial statements, we can click into income statement and start to understand where their revenues come down to their net incomes and some helpful supplemental items down here, where they calculate EBITDA, where they calculate EBIT down here, calculate their effective tax rate, all the way down to some other operating expense margins items like how much they spent on R&D, et cetera. We can also go into the balance sheet. We can start to analyze how well a company's liquidity is or what their liabilities are looking like, what their working capital commitments are, all the way down the line. We see long-term debt, somewhat significant, but we know that Apple has a very significant amount of cash that doesn't fully offset all the debt, but helps provide them some pretty strong liquidity. And we can see things like book value per share as well. And then, of course, the classic technical question, if you could only have one financial statement to analyzing a company, what would it be? Oftentimes, the answer is cash flow. And this cash flow statement helps us understand what the company has been doing, in this case, since 2017. But just like all the statements, we can expand this out or condense it to what we want to analyze. And we can see how the company returns capital to shareholders. This is one we wanted to look at before when we were looking at the one-year change in shares outstanding. The amount of stock, the amount of money a company designated to paying back stock is really helpful when it comes to understanding what they give back to shareholders. Apple has been paying back a whole lot of stock to shareholders in the past, same with dividends. And these three statements help us understand that. But then if we go into ratios, these statements, the numbers on these statements are given a whole lot more context because we can look at things like return on capital, like return on equity, that take numbers from the statements and provide them with a ratio that makes a whole lot more comparability when trying to assess whether or not it's a good performing company, and helps us see, once again, that trend more clearly. We, of course, want that return on capital to expand. It's expanded quite a lot in the last couple of years. Could that be sustained? Who knows? But these are probably two numbers that are really indicative of the overall stock performance, which for Apple has been very strong. And the last one will be multiples. Multiples help us get a picture of what we've been talking about, how the company is valued in terms of some form of financial metric. We can see if we go into quarterly, right up here, we can change the frequency. I like to go to annually, which helps me see it on a much more longer term perspective, what the company's multiples have been, aka how expensive or cheap or how the price of the stock has looked. And when we look at Apple, this is the real big story here. If we look at 2016, they traded for 5.5 times LTM EBITDA, an extremely low multiple that if we saw Apple trading that low today, we would buy it in a heartbeat. But we see that multiple has really expanded all the way up to 20 as we sit right now in March of 2022. And all across the board, immense multiple expansion came in. in the form of Apple stock. And for those that bought Apple way back in the day, few years ago. I think Warren Buffett, he did quite well. Those that could appreciate a huge amount of multiple expansion have really appreciated owning the stock. And we can see how the multiples have been outlined over time to really help our investing analysis. And the last couple that I'll quickly touch on, CIQ estimates, which are on the left-hand side here. If we go into CIQ estimates, this helps us get a picture of what analysts are projecting in terms of financial performance over the next several years, because Apple is a large company. Many analysts are covering it, and many have target prices. Many have projections about earnings per share, revenue, EBITDA, etc. And the last will be news, events, and filings. If we go down to this tab here, I like going into SEC filings because we've analyzed all these numbers courtesy of CapIQ. But if we want to take it straight from the mouth of Apple, we will open any one of these SEC filings, 10Ks and the 10Qs, to get a picture of what they were reporting as raw data to the SEC, which is the basis of what strong investors use to make decisions. And these filings are really helpful and all available here for investors and all helpful for analyzing the stock. And the one last one that I'll indicate is transcripts. If we want to get better context about what drove a company's earnings in each respective quarter, or how management was talking about additional investments, where management has said they will want to invest. Maybe Apple has said that they want to make a new technological product. It will be talked about in these earnings calls. And to access earnings calls, let's say for the most recent one on January 27, 2022, we can click the PDF icon here to download the document. And we can see that whatever was said on the company's earnings presentation is outlined and scripted right here for us to read as an official document. Whatever Apple said in their most recent earnings report, which if I remember correctly, was pretty good, this transcript will help us analyze. And we can analyze transcripts over a number of years. A lot of great investors use that as the first step in their process of understanding the trajectory of the company. But when it comes to, you finally chose your company, you started from a top-down approach, you got all the way down to bottom up, and you familiarized yourself with it. You've done all these steps in this video. Hopefully you found a stock that fits your needs. If we go back to the alpha factors, these factors, any one of these factors you can use to make a good investment. But it's just a matter of analyzing those metrics that coincide with them, understanding the macro factors that are driving them, and understanding the individual companies that you want to get exposure to, which you could then, to go back to that final slide, analyze on your own. In this case, analyzing through these steps to get a better understanding of your potential investment. Thanks a lot for listening in and watching. I hope it was helpful, and hope you're able to check out the mill again and find similar videos. Thank you.